Question here by Dave. What about tax differences and benefits buying investment properties under a personal name versus a trust? Let's break it down in this table. So in this table below, I've tabulated the difference between a trust structure and a personal name structure in terms of purchasing your first property or even your second property if it's an investment property. On the far left-hand column, there's 11 rows of 11 things that are different in a trust and a personal name. Let's start off with tax benefits. So under a trust, there's no personal tax rates. You can actually distribute the rental income received per beneficiary. Whilst under a personal name, you as a person who purchased the property bears that under your tax bracket. But in terms of negative gearing under your personal name, you can take advantage of that. For example, you're on a $200,000 income, you made a negative loss through your property purchase and, rental loss about $30,000, you only are taxed at $170,000. Whilst for under a trust, there's no negative gearing benefits. You can't do that. However, under capital gains discount, both trust and personal name, you are eligible under the 50% CGT discount. Make sure under the trust structure, it's a family trust. In terms of asset protection, if you run a business and you're buying property and you want to protect yourself against other people going after your property, asset protection is very high under a trust, whilst under your personal name, if you get sued, they can go after your properties under your name. In terms of income distribution under a trust, yes, we don't have negative gearing, but then, for example, your property, which is positive geared, made, for example, $50,000 in rental income that year. You don't want to pay tax on your marginal tax rate under your personal name. If you have kids or you have a wife that doesn't work, you can distribute income to them to lessen the burden on your tax rate. Whilst under a personal name, if you purchase an investment property under your personal name, for example, your income is like $160,000, your tax bracket is at like 37%, but then suddenly you derived a positive income rental property of say $40,000. It goes over the 180, 190 mark. Now you're taxed at 45%. In terms of complexity of setup, under a personal name, very easy. You just purchase the property under your personal name, done, that's it. But under a trust structure, number one, you'll get financial advice. You got to ask your accountant about the pros and cons of tax consequences. And also, you got to set up a corporate trustee, not an individual trustee. Certain banks don't accept individual trustees. And then there's a lot of audit requirements every year for tax returns. And of course, with the complexity, the ongoing management cost is very high. Well, not high, I would say. Setup costs $2 to $3 grand for the corporate trustee, and every year, tax returns wise, about $1,000. Whilst for a personal name, very minimal, under $500. In terms of flexibility in changing beneficiaries, under a trust, it's very, very good for estate planning. What that means is you have a property, you're nearing the age of retirement, you're planning to give that property to your kids, and for example, you originally wanted to give this property to one kid, they're not listening, you change the beneficiary. But under your personal name, it is very difficult to change the ownership, especially when you're transferring to another person, to avoid CGT. Whilst under the trust, you can change your beneficiary around without triggering CGT. And when it comes to capital gains distribution, for example, you purchased a property at $500,000, after 10 years it's about $1.5 million, and you made a $1 million gain, all right? So under the capital gains distribution, under a trust structure, if you have multiple beneficiaries, you can distribute the capital gains to each person, especially if you're the main income earner and you have other parties in your family that are not earning anything at all. You can distribute income to them so that they get taxed at their lower marginal tax rate. Whilst under a personal name, if it's under you or your wife and you're earning like 200 G's when you're 45, add $1 million on top of that, and you're going to get killed in terms of tax. However, I do need to note, under the 6-year CGT rule, which is if you bought a PPOR and then you sold it within 6 years, under a trust, it doesn't apply to you. Whilst under a personal name, you can get tax exemption if you lived in that property for a minimum of 12 months and you sold it within 6 years. And the biggest benefit of buying under trust, which was my previous video, is that some banks can't see the debt in the trust structure. Whilst if you bought it under your personal name, it's all to see. They can see every single thing. What color is your undies? They can see it. So hopefully, Dave, that answers your question in terms of buying a property under a trust structure or a personal name structure. Jump in the comments, let me know what you think. And if you want a tailored strategy plan to discuss how your investment journey can be improved through a trust structure, book a call. Love to speak to you.